What's up, viewers? Welcome back to our channel.
I'm Shopbilicious.
And I'm Donorific.
And we are the Math Genius.
In this video, we're going to embark on a journey in discovering the mystical world of revenue, expenses, and profit.
And let's not waste any of our time and let's start discovering the first thing that we will be talking about this day, which is called the revenue. Yay!
Revenue. Revenue is a form of income that is earned by the sale of goods or services. It is the earned amount of money without subtracting costs and expenses related to the revenue, such as overhead, wages, commissions, cost of productions, and taxes. All revenue is income, but not all income is from revenue. Income can be thought of as an increase in wealth from any source. Some examples of income include sales revenue, wage income, salary income, investment income, such as distribution of dividends or profits where you own a part of a business, interest income, profit from the sale of an asset that has increased in value, such as a stock or real estate. Examples of revenue accounts include sales, service revenues, fees earned, interest revenue, and interest income. Revenue accounts are credited when services are performed or billed and therefore will usually have credit balances. Every type of businesses earn revenue differently. For a service type of business, they earn something by the services they provide to customers, while merchandising type of business generate income by the finished products they sell to the market. And lastly, manufacturing companies generate income by making tangible output from raw materials or inputs.
We're done now with revenue. Now let's discover the mystical world of expenses.
An expense is the cost of an asset used by a company in its operations to produce revenues. In other words, an expense is the use of assets to create sales. Notice that I didn't say it's the amount of money spent to generate sales, because expenses are created when an asset is used up, not when cash is paid out. Take depreciation expense for example. The expense account is a contra equity account that has a debit balance. This means that equity is decreased as the company generates more expenses. This only makes sense since expenses lower the net income or profits of the company. You can see this clearly in the expanded accounting equation where equity equals owner's capital minus withdrawals plus revenues minus expenses. As the expense account increases, the total equity of the company decreases. There are three major types of expenses. These are fixed monthly expenses, variable expenses tied to revenue, and variable expenses tied to inflation. First, fixed monthly expenses are expenses that are just the same every month, no matter what your revenue is. For example, maybe your internet bill is going to be the same no matter what happened. Then, variable expenses tied to revenue are expenses that scale with revenue. These are typically a percentage of revenue. For example, if you are operating a restaurant, your food cost will typically always be a percentage of revenue. And lastly, variable expenses tied to inflation are some expenses that basically stay the same, but should just plan on increasing maybe 2 to 3% each year. This could be things like rent, phone bill, utilities, and office supplies.
And now we're done with revenue and expenses. It's time to discover what will be the outcome if we deduct the expenses. Let's now explore the world of profit.
Apparently, profit, also called net income, is the amount of earnings that exceed expenses for the period. In other words, it's the amount of income left over after all the necessary and matched expenses are subtracted for the period. Notice that I didn't say all the expenses that were paid during the period because, according to the matching principle, all of the expenses that were incurred to produce the net income must be recognized in the period in which the revenue is earned. Thus, some expenses that aren't actually paid during the period are still subtracted from income to arrive at the net income for the period. Profits are reported on the bottom of the income statement and are traditionally viewed as the amount of money left over after all expenses have been paid. This is why many people call the net income the bottom line of the company. Results of operation of a business may vary because we'll call it net profit or net income if revenues are higher than costs and expenses, while we can call it net loss if revenues are lower than costs and expenses. And there is such thing as break-even if revenues are equal to costs and expenses.
That's all for this video. I hope you became fully familiar with the concepts of revenue, expenses, expenses, and profit.
May you never get confused on differentiating each one from another. We hope that we help all the aspiring entrepreneurs out there. Again, I'm Shell Delicious.
And I'm Dr. Rifik, and we are the Math Idiots. Bye!